Welcome to Market Tape, a weekly capital market show. There are two things I want to achieve on this show. First, to help you make sense of weekly events in the Nigerian capital market as well as the global capital market. And then secondly, to show you how you can use the insights gleaned on this show to improve the performance of your portfolios and take your investing game to the next level. And if this is what you are looking for, then I urge you to subscribe to this show immediately. My name is Nathan Mokoro, and I'm your host. One man has been in the news an awful lot lately. I'm sure you can guess who I'm talking about. It's Alhaji Aliko Dangote, the richest man in Africa. Earlier this month, he spoke about how high interest rate was hurting manufacturers. In his words, he said, no one can create job at an interest rate of 30%. No growth can happen. Speaking about the economy. So he's saying that the economy cannot grow with interest rate at 30%. Only last week, in a move that seemed to underweight Dangote's position, the central bank raised its interest rate by 50 basis points to 26.75%, the highest in the history of the country. So what does this mean for investors and businesses? Last week also, we saw mixed results from a couple of blue chip companies on the Nigerian Stock Exchange, talking about Transcorp PLC, Transcorp Hotel, Dangote Cement PLC, Okomu Oil, and even Airtel. Despite the fact that some of these results were impressive, the Nigerian stock market declined by 2.33% for the week. I think a lot is going on the Nigerian capital market, and you should stay with me as we discuss this. In the US capital market, we also saw results from Google, Tesla, Enphase Energy, and a couple of healthcare companies. They all posted their quarterly reports last week. Particularly, the report from Tesla was far from impressive. For Google, they had a fairly impressive report, apart from their YouTube and ad revenue not living up to expectation. The US market itself, speaking about the S&P 500, declined last week also by 0.83%. These are the issues that we're going to be talking about this week. Before we get into it, I want to share a comment made by Ugo Dre of Nairametrics. I'm sure many of us know him. And by the way, he's doing a phenomenal job for the Nigerian investment community. Whether you're looking at the podcast he's having or the values, the benefits we're getting from Nairametrics itself is immense, and he deserves all the credit. Last week on his podcast, he was speaking about the ongoing recapitalization exercise of Nigerian banks in compliance with the directive of the central bank to raise their capital to 200 billion naira for national banks and 500 billion naira for international banks. And he was speaking about what investors need to know around these issues. Take a listen to this.
What I just want to address quickly is something that a number of people have brought to my attention, which is, all sorts of people trying to tell you to buy one stock or the other for public offer, especially account officers of banks. I got a call recently from an account officer, and that chap hasn't called me in a while. Can't remember the last time he called me. That's if he has even ever called me. And he called and, of course, was pitching to buy one of those public offers. And I've got someone else as well who told me, my account officer told me to buy this. And no one says, my cousin told me to buy that, and blah, blah, blah. Guys, never, ever, ever buy any stock, whether it's public offer or right issue, because someone is marketing it to you. I don't like to demarket people or to, and the stuff. But stocks are not products. Stocks are not like consumables. They're not goods and services. They're investments, and I just don't think it's right to market investments like the way some account officers market it. Even if you must market investment, it has to be marketed by people who understand investments, people who can give you proper, investment guide or investment ideas or suggestions, or can at least explain some of the things that they are marketing.
I mean, shout out to Ugo Dre for leading this conversation. And his points are extremely important. I thought it's something that I need to share here for us to be aware of. And to be clear, none of this is a knock on any of the banks. I mean, if you look at the Nigerian banks, most of them are grossly undervalued. So if you're looking at their price to book ratio or price to earnings ratio or their revenue growth over the last couple of years, it's been quite impressive what these banks are doing. And by extension, these banks are some of the most undervalued assets, not just on the Nigerian Stock Exchange, but among peers in sub-Saharan Africa. So the issue is not about attractiveness. The current prices are very attractive. Sound investment cases, investing in these stocks. But there are critical questions you need to ask before making any investment decision. And one of the facts is that these banks have been undervalued for so long. I mean, for the past 15 years, most of these banks have been trading at very cheap valuations. So the question you need to ask first is, why have these banks been undervalued for so long? And then when will the correction, which is what we expect, that if you're buying an undervalued asset, the price should correct over time. So you want to ask, when will the price correct? And this uncertainty is what introduces risk into the equation. So it's important to be discussing these issues with a professional rather than an account officer or some persons who are trying to get you buy these stocks, buy these shares for commission. So you want to make sure that you are discussing the relevant issues with a professional and making sure that these investments aligns with your risk threshold and your investment objectives. So when it comes to investing, we have different things to consider. You need to consider your investment time horizon, you need to consider your own risk appetite and your return expectation. So if you're not putting this in perspective, then something is wrong. You need to get someone who will help you put them in perspective before making investment decisions. And this is what Ugo Dre is talking about. I just felt I needed to put this out there for us to be aware of, because on my own, I've also gotten a lot of calls asking whether to buy these public offers or not, whether to take advantage of our right issues or whether to let it go. So it comes down to having those critical decisions with an unbiased professional, someone who is not in need for commission or who is not under pressure to ensure that the sales is successful. So that to me is very important. Now to the discussion of the day. The CBN raised interest rate by 50 basis points to 26.75%. It would appear as if the CBN is not is oblivious of the plight of businesses in Nigeria and individuals. Actually, we have all been privy to the biting inflation in the country and how businesses are folding up, how businesses are hurting from inflation. I mean, if you look at the earnings result last week, Dangote, Airtel, the common story among them is high operating expenses. So it's a big deal, and you wonder whether CBN is not aware of these issues. Again, if you look at the comment from Dangote earlier this month, he was speaking about the fact that economic growth cannot happen at a very high interest rate, because this is what happens. with high interest rates, businesses are going to struggle to borrow money from the banks. And where they even manage to borrow, they are borrowing at 36%, as high as 40% in some instances for small businesses. The struggle is real when it comes to how interest rate is hurting businesses. So the point is, why is CBN still raising interest rates, knowing that businesses are suffering and then this will slow down the economy? Okay, to start with, the key thinking of the central bank is that they need to keep these rates high, primarily to keep attracting foreign portfolio investors. Because by the CBN's estimation, one factor that is accounting for the level of inflation we are seeing today is exchange rate. In form of imported exchange rate in form of imported goods. We all know that you need exchange rate to bring in petrol, to bring in processed food into the country. And most of the pressure we are seeing on food and commodities in Nigeria, including services too, comes from high exchange rate. The central bank's perspective, if they manage to get exchange rate stabilized, then they should be able to get a hold of inflation. But we also know that exchange rate is not the only factor accounting for inflation. We know that most of the parts of the country, people can go to farms to bring in agricultural commodities into the market. And it's part of what is stoking inflation. We know that. But there is little CBN can do in that regard in terms of getting farmers to farm. I think it's beyond their responsibilities. So for the central bank, what is in their control, so to speak, is getting a hold of the exchange rate. And in some regards, they've been somewhat successful stabilizing exchange rate. In the past 1 month, exchange rate has been between 1.5 to 1.630 max recently. So for the central bank, they want to keep attracting foreign portfolio investors through the issuance of OMO, that is the open market operation. They want to keep attracting the foreign investors through these platforms. And it's important to them, really. Again, if you look at the global interest rate, in the US, for instance, rate is still well over 4%. So again, the CBN is in direct competition with major central banks around the world. In the US, for instance, interest rate is well over 4%. That is yield on bonds and treasury bills is well over 4%. So the central bank needs to keep rate as high as possible to attract these investors until we start to see a slowdown in the rates in this major market. We're expecting in September for the Federal Reserve to commence cutting interest rates. So hopefully when they start cutting interest rate, CBN will be able to slow down on the rate hike in Nigeria. But there are people who are not complaining about this interest rate hike. That is speaking about investors in the fixed income market. Today, based on the most recent auction at the Treasury bill market last week, I think on Tuesday, the closing rate, the stop rate for the 364 days closed at 22.10%. I think 182 days closed at 19.5 and 90 days closed at 18.5. These figures I'm calling out is the highest we've seen in years, for so many years. I don't think we've seen rates in the Treasury bill market reach this level. Effective yield on the 1 year Treasury bill is about 28%. This is pretty high, and investors can use this to protect themselves against inflation. We also had a bond auction last week, and the 2033 bond closed at 21.98%, 2031 closed at 21%, 2029 closed at 19.89%. All these rates are historical highs. We've not had rates in the bond market this high any time in the history of the country. So for investors, it's an opportunity to further diversify portfolios out into the fixed income space and get some very substantial income in form of periodic, these bonds pay coupon every 6 months. The treasury bill is upfront. So whether you're looking to plan payment of school fees, rent payments, or just to have steady inflow of funds, whether in retirement or for any purpose, these bonds provide very attractive opportunities to do that. So moving on to the Nigerian stock market. Like I said, the stock market closed at lower by 2.33% last week. And a couple of factors are responsible for this. I touched on the fact that Mr. Aliko has been in the news a whole lot lately. We saw the back and forth between the Dangote refinery and the NNPC and the NMPDRA, the regulator in both the midstream and downstream sector. We saw the back and forth, the accusations and counter accusations between these guys, And as everyone said, this back and forth is not good for the market. It's not a good look for the Nigerian market, and obviously it had to reflect on the stock market. Most of the blue chip companies closed lower last week, from the banking sector to the industrial goods sector. Most of these sectors closed significantly lower last week. So we saw a net decline of 2.33%. So whatever we do, I think the authorities need to, or the parties involved need to understand that these utterances in the public space have a consequence on businesses and probably need to moderate what we say. I mean, some of these issues could have been trashed out behind closed doors, whether you're talking about the accusation that the products were substandard. I mean, the regulators could have written off formally to them to say, this is what we have observed, get a response, and trash it out behind closed doors. I don't think we need to have this information as in the public domain. I think it's bad for the market, and I hope that those responsible are watching this. We also had some mixed performance from the companies that reported last week, particularly Dangote Cement, Okom Oil, and Airtel. These results weren't so impressive because of pressure from currency revaluation gains on the part of Airtel, and then just inflationary pressure on Dangote and Okom Oil. The results weren't very impressive, but still very good and decent numbers from these companies. We also had very impressive numbers from Transcorp Incorporated, from Transcorp Hotel, and FCMB. But despite this impressive result, it failed to lift the exchange last week. Also, you think about the level of interest rates at a yield of 28%. Most equity investors will reconsider staying put in the equities market. So you have a direct competition between the equities market and the fixed income market. So I'm sure we saw some rotation last week from the equities market to the fixed income market to take advantage of these very high yields. Also notably, last week the banking sector underperformed. Last week we heard about the plan of the government to implement a special taxation on the exchange rate gains declared by banks in 2023 and keep doing that to 2025. And again, I'm struggling to understand why that is happening at this point in time. On one hand, it impacted the market. If you look at the banking sector, so if you look at the banking index, it declined by 2.94% last week, following this proposed special tax on bank exchange rate gain. So what the government is saying is, these banks following the liberalization of exchange rate, we moved from about 400 and something naira to now, at the end of last year, we're around 1,000 in exchange rate. So on foreign currency assets held by this bank, they all booked profits on their foreign currency assets. So what the government is saying is that they're going to apply a 70% tax. Yeah, the president had initially proposed 50%, but took it to the National Assembly, and the National Assembly raised that to 70%. And obviously the banks see it as unfair. Investors are not happy with this move by the government because it's like clawing back a substantial part of their earnings. On the other hand, I'm wondering why the government is even doing this at this point in time. We're at the point where the banks have been mandated to raise their capital base by, in some instances, over 200%. If you look at the banks that have, most of the banks on the average have current capital base of 100 and something billion, and they are supposed to raise it to 500 billion for international banks. So many of them need to raise twice their current size of capital. And at this same point in time, the government is charging them this special tax of 70% on their foreign currency revaluation gains. I don't think investors, that move sits well with investors. And it's going to make the job of the banks to raise this capital a bit more difficult, because investors are going to look at, factor that into their expectation for profitability from now till 2025. So it's something that we are looking at also. So as investors, how should we position with all of this going on? In our mid-year podcast, we actually spoke about a couple of companies that we feel have the ability to weather all of these storms and come out from them stronger. I think about 9 companies. So for investors, basically what we think we need to do is to look at the long-term prospects of these companies, not just what is going on today. Whether you're looking at the industrial sector, whether you're looking at the telecommunication sector, whether you're looking at the banking sectors, and of course the agri sector where you have Okom Oil and Presco. Some of these events will make their valuations a bit more attractive. I know Dangote Cement, for instance, has had a very impressive run over the last couple of years. And last week I think they lost about 11%. So for an investor who is looking for a good entry point, I think it's opportunities like this that such investors should be looking out for. So that is that for the Nigerian market. And to the US market, coming into last week, the tech sector was under a lot of pressure, particularly the so-called Magnificent Seven. That is talking about Apple, Tesla, Nvidia, Amazon, Microsoft, Facebook, that is Meta, and Apple. This sector was under a lot of pressure. More so, we saw the outage from CrowdStrike, one of the cloud security service providers in the US, that led to the disruption of the operations of a lot of big businesses around the world. That was fixed subsequently, but all of these events led to a slowdown in the incredible run we've seen with these Magnificent Seven stocks over the past couple of months. Leading since 2023, around August last year, these 7 stocks have been driving the market. And if you look at their return over this period of time, you see some of them around 200% return, 100% returns. But that came to a halt 2 weeks ago. In fact, since the beginning of July, their performance has not been very impressive. So there were a lot of expectations coming into last week, because we had Google, that's Alphabet, and Tesla reporting or presenting their earnings report last week. For Tesla particularly, the result was very disappointing. We've seen a significant slowdown in their EV sales, that's electric vehicle sales, saw significant slowdown, and even their earnings declined by close to 45%, compared to the previous year, 2023. And the market was very disappointed with that. So if you see the overall performance of these seven stocks last week, Nvidia lost 8.4%, Microsoft lost 3.95%, Tesla lost 12.6%, and Google lost 8.08%. On the part of Google, their result was a bit impressive, beat expectation in terms of revenue expectation, beat expectation in terms of earnings per share. However, one area where the company underperformed was in terms of YouTube and ad revenue. It didn't live up to expectation. Particularly for Google, Google Cloud, which is the segment involved in the cloud business, we saw a 28.8 growth in revenue, which is quite impressive. But despite that, the share price declined for the week. Overall, what I think is going on in the US market is some sort of rotation, because as I did say earlier on, most of the growth we've seen in the market since 2023 is mostly based on the technology sector, and most of the growth is coming from these seven so-called magnificent seven stocks. So most of the growth is coming from the technology sector, and investors are wondering. Obviously, some of these stocks have reached very expensive valuations, with expectations that the Federal Reserve is likely to cut interest rates starting from September. Investors are seeing that as an opportunity to rotate into other sectors of the market that are likely to benefit from the interest rate cut. And if you're looking at sectors that are likely to benefit from interest rate cut, you're looking at sectors like utilities, small businesses generally, because if you think about high interest rate hurts small businesses that need to borrow money more than it hurts small businesses. So what investors are doing is to say, if the expectation is that interest rates will start getting cut from September 2024, then it makes sense to start to rotate some of the gains from the technology sector into the small cap sectors. Last week, we saw the Russell 2000, which is the index that tracks small businesses, rise 1.78%. That is opposed to the S&P 500 that tracks large businesses, dropping by 0.83%. The Nasdaq that tracks majorly technology stocks lost 2.08%. So in essence, what investors simply did last week is to rotate some of the gains away from the tech companies into some of these other sectors that are likely to benefit from interest rate cuts, like the utilities, of course, healthcare too, and even the financial sector. Most of the banks in the US, both the commercial banks and the international banks rather, and the regional banks saw huge gains. Over this couple of years, because of inflationary pressures, most of these bank stocks have been undervalued. So basically, what investors are doing is rotating out of this technology sector that appears overvalued and searching for where the next level of returns will come from. And obviously, investors are looking at some other sectors. So what we should be doing now as investors is to, diversification is always prioritized when it comes to portfolio construction. Whether by design or by just the recent bullish run we've seen, most portfolios are concentrated in these technology sectors. So depending on our risk appetite, yeah, depending on individual situation, it makes sense to rotate some of these gains into some of these other sectors. I mean, this sort of volatility we saw last week is always part of the market. You can't invest and expect not to see and deal with this sort of volatility. So, as investors, it's welcomed. In fact, it's an opportunity for people who are looking for attractive entry points into these stocks. Nvidia, for instance, got up to $138 per share at some point this year, and came down to around 112 within last week. So for people who are looking for attractive entry points, events like this type of volatility presents such opportunities to get in at attractive valuations. Also, this week we're even expecting more results from Apple, Amazon, Facebook, and Microsoft. So I dare say it's going to be another volatile week this week. So we have to brace up for it. Okay, in terms of how to play these events, whether it's the rotation from large cap to small caps, or the rotation from the technology sector to other sectors like industrials, utilities, and financials. One thing to bear in mind is the US economy has been resilient over this couple of this past 1 year, 2 years. Among most of the major economies, the US economy is one that showed a lot of resilience and strength. One expected coming into 2023 that we're going to see a recession. We never saw that. Coming into 2024, expectation was that the economy will grow around 1.4%. But what we're seeing today is a 2.8% growth in GDP based on the numbers released last week for Q2 2024. In the same vein, the inflation has been well managed. It's come down slowly. The Federal Reserve their preferred measure in looking at inflation is a personal consumption expenditure. That's a PCE. It came out to 2.6% last week, which was better than expectation. So everything is aligning for a rate cut in September, obviously. And that points to a strengthening of the market. We saw a rebound in the stock market on Friday when those numbers came out. So it's a good news for the market, and even for these businesses. One doesn't expect them to slow down in their earnings. The earnings reports, what we saw from Google, Tesla was a bit disappointing, but we have to put that in perspective. For instance, Tesla's business is not all about selling EVs. One of the most anticipated segment of their business is the robotaxi, which unfortunately they've kept deferring the launch. I think currently it's projected to launch in October this year. And so we'll be looking to see what happens with the robotaxi. And then again, we also saw some impressive growth from their battery sales, battery sales for solar systems. And there's also some expectation that the company will soon ramp up their investment in artificial intelligence. So there's still a lot of prospect with Tesla and even Google too. Google is the king of cloud computing. There's no way you can slice it. In fact, they have some sort of serious monopoly in that business. The only major competition they have is from Amazon and Microsoft to some extent. So they have an unparalleled dominance in that segment. So already this year, we've seen an impressive run in the stock of these companies. And as we get into the second half of the year, investors will start to look at what happens next year. And there was a report by FactSet And that report indicated that majority of the companies that have reported so far reported positive earnings surprises. And we expect that to carry over into 2025, especially on the back of these strong GDP growth numbers that we're seeing. So overall, I expect that the US economy still remains attractive, but along the line, we're going to see these bumps, we're going to experience these volatilities. As investors, we welcome them and use them as opportunities to buy into stocks that we like if we see them at attractive valuations. I mean, personally, as an investor, I am always looking out for events like this that will drive the share prices down, because that is how you build wealth, that is how you build your portfolio. That is how over a long period of time you look back and you see impressive performance from your portfolio. This week we expect even more volatility as we await reports from Microsoft, Amazon, Facebook, and Apple, the other members of the so-called Magnificent Seven. Thank you for watching, and I hope you enjoyed this episode. If you have any comment, questions, or any topic you want us to talk about, do well to drop it in the comment section. And please subscribe. See you next time.